TheGlobe.com. The most vivid memory of the IPO bomb dates back to an early morning in November 1998 when it was being interviewed on a TV show. As I waited in the green room, I thought how out of place it was to be sitting next to two young men dressed in jeans who, while in their early 20s, looked like the teenagers. But little did I realize that they were the first superstars of the internet bomb and the featured some attractions on the show. Stephan, Paternot and Todd Krizelman had formed a company called TheGlobe.com inside the dorm room at Cornell. Their company was an online message board system that hoped to generate large revenues from selling banner advertising. In earlier times, one needed the actual revenues and profits to come to the market with an IPO, but the Globe.com had neither. Nevertheless, this was a new era, and their bankers, Credit Suisse First Boston, brought them to the market at a price of $9 per share. The price immediately soared to $97 at the time, the largest first date gain in the history, giving the company a market value of nearly $1 billion and making the two founders multimillionaires. That was the day we learned that investors would throw money at the businesses that only 5 years before would not have passed the normal due diligence hurdles. The initial public offering of the Global.com was the catalyst that launches the pathological path of the internet bubble. The relationship between the profit and the share price had been severed, and a wave of the money-losing ventures rushed to the market with IPOs. As the Patronot CNN segment in 1999 discussed him at a trendy New York nightclub dancing on the table in this shiny plastic black pants with his trophy, the model girlfriend. On camera, Patronot was hard to say. Got the girl, get the girl, get the money. Now I'm ready to live a distinguished the favorable life, where life may be the disquieting now that Paternot and Krizelman are known as the global poster boys of the internet exists. As for the Global.com, the company closed its website in 2001. In Paternot's tell-all book, a very public offering, he admits how little he knew about how to run a company. So main principled experience as a businessman, he writes, towards the constant sense of being on the verge of death, always pushing as hard as possible and in constant denial of the inevitable. While the party was still going strong in early 2000, John Deere, a leading venture capitalist with the preeminent form of the Kinder Perkins, called the raise in internet relative stocks the greatest legal creation of the world in the history of the planet. 2002, he negated to the right that it was also the large destruction of the wealth on the planet. Okay, let's go to the next paragraph. Securities analysts span up. Wall Street is a high profile. The securities analyst provides much of the hot air flooding the internet bubble. The analysts such as Mary Mercer or of the Morgan Stanley Henry Woolgate of Merrill Lynch and the Jack Gubman of Solomon Smith Barnard became the household names and were accorded the statue of the sports heroes or rock stars. Miller Mecker was adopted by the Born magazine the Queen of the Net. Woolgate was known as the King Henry, while Gauman acquired the Sobriquet Telecom Guru, and in the words of unworshipful CEO was almost a demigod. Like sport heroes, each of them was earning a multi-million-dollar salary. Their incomes, however, were based not on the quality of their analysis, but rather on their ability to steer the lucrative investment banking business to their firms by implicitly promising that their ongoing favorable research coverage would provide continuing support for the initial public offerings in the aftermarket. Traditionally, a Chinese wall was supposed to separate the research, the function of the Wall Street firm, which is supposed to work for the benefit of investors, from the very profitable investment banking function, which works for the benefits of the corporate clients. But during the bubble, that world became more like the Swiss cheese. Analysts are the very public, the cheerleader for the bomb. Woolgate fleetly states that the traditional valuation metrics were not relevant in the Big Bang stage of the industry. Mecker suggests in a flattering New York profile in 1999 that this is the time to be the literally legless, nationally legless. Their public comments on individual stocks made prices soar. And why not? The stock selections visually it's a word that's described in terms of powerful baseball hits. A stock that would be expected to quadruple was for bigger, more exciting stocks might be the 10 beggars. And as the industry standard remarked when the Mary Maker tells, NASDAQ go bananas. Securities analysts always find a reason to be bullish. They seldom utter the four-letter sell word because they do not want to endanger current or future investment banking relationship or to offend corporate chief, the financial officers. Traditionally, 10 stocks or rates buy for each one rate sell, but during the bubble, the ratio of the buys to sells reached close to the 100 to 1, and as the stocks climbed more and more, Americans became so convinced that investing was easy. They watched the CNBC to listen to interviews with their favorite investment gurus, and they could not get enough of the fluff the analysts were peddling. When the bubble burst, the celebrity analysts faced the death threats and lawsuits, and their firms faced investigations and fines by the SEC and New York State Attorney General Elliot Spitzer. Blodgett was renamed the Crown Prince of the Internet bubble by the New York Post. Government was ridiculed before a congressional comment for his continuous tooting of the WorldCom stock and investigate by the Attorney General Spitzer for changing his stock ratings to help obtain investment banking business. Both Belgard and Gutman left their firms. Fortune magazine zoomed it all up with a picture of the Merry Maker on the cover and the caption, "Can we ever trust Wall Street again?" Yeah. Okay, let's go to the next paragraph. New valuation metrics. In order to justify ever higher price for internet-related companies, security analysts began to use a variety of new metrics that could be used to value the stocks. After all, the new economy stocks are a breed apart. They should certainly not be held to the fuddy-duddy, old-fashioned standards such as price-earnings multiples that have been used to value traditional old economy companies. Somehow, in the brave new internet world, sales revenues and profits are relevant. In order to value internet companies, analysts looked instead at IPOs, the number of the people viewing a web page or visiting a website. Particularly important are the numbers of the engaged shoppers, those who spend at least 3 minutes on the website. Merrimaker gushed enthusiastically about the drugstore.com because the 48% of the eyeballs viewing the site were engaged shoppers. No one cared whether the engaged shopper folks over greenbacks and bought anything. Sales were so old-fashioned. Drugstore.com reached a price of $67.50 during the height of the bubble of 2000. By the fall of the next year, when the eyeballs start looking at the profit, it was a penny stock. Mindshare was another population non-financial metric that convinced me that investors had lost their corrective mind. For example, online home seller homestores.com was highly recommended on October 2000 by Morgan Stanley because the 72% of all the time spent by internet users on real estate websites was spent on properties listed by homestores.com. But mindshare did not lead to internet users making up their minds to buy the properties list, and did not prevent homestore.com from falling 99% from its high during 2001. Special metrics were established for telecom companies. Security analysts clambered into the tunnels to count the miles of fiber optic cable in the ground rather than examining the thin fractions that was actually lit up with traffic. Each telecom company borrowed money with the abandon, and enough fiber was laid to circle the earth 1,050 times. As a sign of the times, the telecom and internet service provider PSI Net, now bankrupt, but its name on the Baltimore Ravens football field. As the prices of the telecom stocks continued to skyrocket well past any normal valuation standards, security analysts did what they often do: they just lowered their standards. The ease with which the telecoms could raise money from Wall Street led to massive oversupply to much long-distance fiber optic cable, too many computers, and too many telecom companies. The industry literally choked to death. In 2002, even mighty WorldCom declared bankruptcy, and the big equipment companies such as Lucent and Nortel, which had engaged in risky vendor financing deals, suffered staggering losses and laid off tens of thousands of workers. About $1 trillion was thrown into the telecom investment during the bubble. Most of it has simply vaporized. One of the jokes making the rounds of the internet in 2001 went as follows. Tip of the week: if you bought $1,000 worth of Nutter stock 1 year ago, it would now be worth $49. If you bought the $1,000 worth of the browsers, the beer, not the stock, 1 year ago, drank all the beer, and traded in the cans for the nickel deposit, you would have $79. My advice to you: start drinking heavily. By the fall of 2002, the $1,000 put into Nortel stock was worth only $3. So far, I read some paragraph. A couple of the paragraphs show us some bubble and internet, some telecompanies, some bubble risky, and so on. So in my case, I believe the chemical industry is really strong in the future, because the many things made of the chemical raw materials and so on is based on the oil, the crude oil element. So now very worried about some climate change. It's like climate risk. And on the other end, it is some essential thing to we survive in the world. So in my case, I usually invest the chemical field, oil, some that kind of things, because it's really stable compared with some the internet and some technology. I mean, it's a new technology. So when I read that paragraph, I thought so. It's my so what I have some investment mindset. So okay.